All right. So just a note from yesterday too. All of the uh, recordings are back on the website with the slides from yesterday and the next 2 days. And then we'll also record the pitch prep tomorrow and the pitch prep on Wednesday. So you'll have a chance to listen to the feedback. And then today we'll have two local teams from Bahrain that'll be talking about pricing and what they learned about their metrics. And we'll spend some time on that after the break. And then after lunch, we're going to talk about traction and product market fit. And we'll get a local team for about 30 minutes at the end of that part as well. So that's kind of our day today from an agenda perspective. Let me pull that one up. So we're going to talk about the 14 revenue models, how startups make money. The good news for you in this section is that your idea is hopefully unique, but how you make money is rarely unique. And I'll walk you through the background on the research project that started innocently enough. We'll talk about pricings and metrics that matter after the break and before lunch. We'll talk about go-to-market and what you're going to do for your go-to-market plan. And so it's going to be very tactical today around what's the plan we're going to go first with as we look at launching. So if you get in and get the capital from the program, how do you actually do your go-to-market plan? So if you're not a marketer or don't have a sales background, no worries. We'll get you through a go-to-market plan today. We'll also talk about traction and product market fit. What does it look like? How do you know when you have it? And how can you compress the time frame to get there? As I mentioned yesterday, you really have two epochs of time, right? There's stuff you can work on today in your startup that just doesn't matter. If you don't have product market fit, you don't really have a company, right? And the big thing is de-risk the investment that you are making as an individual so that you can prove out your idea as quickly as possible. And then we'll go into straight pitch reviews, and we'll have a couple hours at the end of the day where you'll get a chance to, if you don't have the start of your slides done or your 10 slides done yet, we'll go through your pitch using the Mad Libs pitch. If you have the start of your slides done, we can go through those ones today as well. So it really just depends on where you're at with it. And I'll be giving you feedback today. And then tomorrow, when we do that, Sala and some of the team from Flat6 will also be giving you feedback. So we'll kind of break those up into breakout rooms, and you'll have a chance to get feedback from both Sala and me. Sala is one of the selection committee team members, to remember. And then you'll get a chance to meet the other selection committee on next Monday. So that's the agenda for today. So on that note, questions from deliverables from last night. How did you do on your awkward co-founder discussions? How'd you do on figuring out your market research? Like, did you start to make a dent in those things last night?
From my side, it was challenging because my co-founders, one is based in Sydney, and the other founder is moving from Saudi to India and then back to Sydney, so we couldn't.
Yeah, no worries. All right, Omar, see a hand?
Yeah, I'm having a hard time for the first one, which is track your venture ready score before and after. How can I do that?
So the link to that blog post you can do on the form. You can track the score yourself. So the before and after is just yesterday. Going into the program, what was the score? And then what I really want you to look at is where were you weak, right? Where were you a 1 or a 2? And let's get an answer to those questions and preemptively get ready to how are you going to pitch around that problem, right? Rather than be like, oh, I walked into a buzzsaw and didn't see it coming. The answer is, nah, we knew what they're going to look for. So how do we answer that? Like, for example, if you don't have a solid team yet, what are you going to do to go get the team that you need? Or can you find an outsourced partner to help you build the product? Right? Or if you don't have a path around building a moat, or like I said, the competitive analysis question yesterday. So it's really helping you to answer the questions in advance before they ask.
Okay.
And then when you're done with the program, I encourage you to rescore yourself again. Just look at it and go like, do I feel like I answered the question well enough that the selection committee look at it next Monday and go like, Yep, we got a good solid answer to that question.
Okay.
So from their perspective, what they're after is not only do we want the teams to get in the program, we want them to successfully get out, get launched with that 45K. So when the selection committee thinks of it, then they're going to ask those questions and go like, how is he going to get past this one, right? In the time frame required. So yeah, that's the objective.
Yeah.
As for me, well, my app was done anyways, and we had a soft launch. So we have a pretty much solid plan, because as well we had hired, for example, for, as you call, teams, we have contacted schools, private schools actually, because a lot of schools, like high school kids, they have to do some creative action services for their IB or A-level stuff. So we have a couple of interns which they need what they call it, sorry, resume, I think. Sorry, and a letter from us in the end.
Yeah.
So we did kind of like way of thinking of plans of how we can have cost efficient, having a good team around us, building it quite different as well, and how we going to market it as well. We have thought of it, how we're going to get more practitioner, but I put a plan like within a month, how much am I going to get a practitioner in 2 months, 3 months, and so on, and where we're going to see ourselves from now till 6 months. So I pretty much had those, me and my sister as well, because she's the CEO. So we had those plans for some time actually.
Good. We'll talk more about your company roadmaps tomorrow, because that'll end up being a slide that puts out a time frame, and I'll probably get you more into quarters, like, because what I'm mostly concerned about at the stage that you guys are at is getting stuff into a monthly format. Feels like there's a level of precision that you just don't know yet, where I kind of look at it on a quarterly basis and say, we're going to make these critical hires here. We think we're going to get this many new customers in this quarter, but I tend to think of it in quarters rather than as precise for months, because it's not really
realistic.
You don't have enough data yet, right, to put together a forecast.
Yeah.
So
well, yeah, it needs funds.
Yeah, exactly. You're perpetually in a catch-22. All right, so let's talk about how startups make money. And so the key here is that you really need to focus on, there's a number of costs you need to figure out how to cover. You have the cost to build the product, the cost to sell the product, the profit, which is going to be viewed as a percentage of gross profit, and the price. So we'll talk more about pricing as well, but what I want you to really cover today is those are kind of your variables. If you think about this as a financial model and a forecast, as you start to put together your financial template, you need to put numbers in for that. So you have a cost associated with, do I hire a CTO? Do I hire a development team? Do I hire an offshore development team or a nearshore development team? And what for these, all of these have to be known numbers, or if they're unknown numbers, I need to push you to get to an estimated number. So do I think it's going to be $30,000 to build the product? And how much do I think it costs to sell the product? Do I think the industry percentage is going to be 65% or 85% gross margins? And what will the market pay, or what will the market bear for the pricing? So there's going to be a lot of assumptions that we're going to work on as we think of financial models. But the goal here is that you get to a set of numbers, right? And you have to move past the concept into actual going like, we're going to pick a number, right? And here's our pricing number. So when we talk to the local teams, they'll talk about what they learned through the process, as far as what they thought they were going to do and what they actually ended up doing. So I want to move you from being unknown about some of those things to being known, which means you're going to have some hypothesis around it. Now, some of these things like pricing, when you start, you'll be wrong, and that's okay, but you have to pick a number, because customers can't react to something unless you pick a number. So what we'll have to do is work you through that process of selecting a number, seeing if it's the right number or not. Okay. So a couple notes on how not to make money. So, which sounds obvious, but you'd be surprised. So small transactions value is bad. So for example, making 10% margin on a marketplace, you're probably going to need to be in the 20% margin versus a 10% margin. I talk to founders all the time that talk about having, hey, we have a low percentage, but we're going to make it up in volume. The problem is the company won't live long enough to actually make it. So Omar, did you have a question?
Yeah, like my pitch is way lower than 10%, but because it is in a wholesale industry,
right,
and it will be per item or per transaction, well, would that be considered as not a good idea? Or?
Well, in your case, the average revenue per transaction is going to be higher, right? So what do you think the average revenue per transaction is going to be?
We are trying to keep it 2.5%, which 2% also goes to the bank.
Right.
For
but
online transactions.
What's the average basket size, the average transaction size? A few $100s or a few $1,000?
No, a few thousand, of course.
Right. So the combination of a small transaction amount and a small margin is where it's bad. Okay. Right. So it's okay to have a small margin if, in your guys' case, you're not actually carrying the inventory of the product, right? It's a transaction.
Yeah.
But if you have a small basket size or small overall value and a small margin, those two things in tandem are really difficult.
Okay.
Right. And like my first company, we had small margins. So you just don't have a lot of room for error. Right. You have to really nail it because you can't miss. Right. So because there's not enough margin in there to have a lot of miss. So, and we'll get through it as we go to your specific numbers for sure.
Okay.
So building a product where you can't capture value, that's a challenge as well. So if you can build it, but like the example of the two products I gave yesterday, it's like, yep, we built it, but nobody is willing to pay for it. That's a problem. Lumpy sales cycle, we talked about yesterday with the academic, the guys who are building the academic gamification one. Lumpy sales cycles are tough. Right. So in the case of selling to academic institutions, there's maybe 2 months out of the year that they're really buying. And then 10 months out of the year, they're in the midst of delivering. So it's very difficult to hire a sales team to sell to schools because they can make their quota 2 months out of the year, which is super demotivating. Right. So you have to figure out the marketing around that and how you can actually drive a sales process that's scalable versus super lumpy. So
I think that's why we have the BTC. We have tournaments, and during the selection, I think in the interviews, we're advised to actually make these tournaments frequent, and that's the core how we want to make our solution popular. Now we're charging the students an optional, let's say $1, $2 to participate in these tournaments. So we want to have them like timely, like it happens monthly, locally. But then we are looking now for tournament organizers because we've already built a partner network for which you will be a host to a tournament and earn commission. So you'd be part of the team that meets schools and talk to them. They get on the tournament, and then it sort of ranks the schools and ranks the students on our leaderboard. So maybe we'll discuss that in the nearest future.
Yeah, and that really comes down to your marketing, right? I mean, the concept here is that because the industry by nature is lumpy, right, from a sales cycle perspective, you have to figure out marketing ways to get around that lumpiness, right? So whether it's increased product sales to DTC when you're not selling B2B, but it's also how do we do the marketing so we can get word of mouth and references and referrals, and you probably won't get to a viral coefficient. We'll talk about that one today, but you will figure out like, okay, what do we do in the off season to make that work? But that can be true for some of the others of you as well. You may have some natural seasonality to the business. And you have to learn to, that shouldn't be a surprise. The more you talk to your customers, the more predictable it will be that there's some natural seasonality to it. So the point here, I guess, is that The customers are going to decide how they're going to buy. Now you have to decide how you want to sell to them so you can extend that sales window, right? So lumpy sales cycles are tough. For some of you, selling to government, for example, is super long sales cycle. When you get it, it pays off. But getting there is a challenge, right? So you really have to figure out, like, how do we get to this milestone if we're going to sell to government, as an example. So sorry for the yawn. And also pricing too low. One of the things we'll talk about in the pricing section here today is that I would rather have you price your product higher and give a discount for the first year than price your product too low, because once you price it too low, it's hard to get the price back up. So it's easier to come back and say, hey, we have this promotion for the first year where we're going to take the average contract value, ACV, and we're going to discount it for the first year, right? Because you're new, because we have, we're a new product, but, and there's some good motivations and direction around how to do that, but you don't want to start your price too low. So the challenge there is it's just tough to get back up, right? So those are some ways to not make money. So every once in a while, I run into a founder who's like, we're doing a free forever product. I'm like, when you're an MVP, that's super hard, right? So if you have a profitable business already, you can do a free forever product. But if you're new, the important thing is we capture value for the value you've created. So Hassan, do you have a question?
Yeah, sorry, Dave.
Yeah.
What if you start as a free trial?
We'll talk about that in the marketing section. So you're B2B, right, versus B2C. So usually a time-based trial will be the answer to the question versus what's called a freemium model. In the case of freemium is really B2C, and it's de-featuring a product, right? So the concept there is I will take a feature out of the product, or I'll give you the simple version of the product. Most of you are launching minimum viable products. So if you took a feature out, it wouldn't be viable, right? So in your case, you could give them a time-based trial and give them 30-day access for free or 60 days access for free. So that's typically the B2B way to go about doing that promotion. Then the thing you'll start to track is what's our conversion rate and how many days is appropriate. Like how many days do I need to give them access, and from the tender perspective, to make sure that they're seeing what the product will do before it gets sticky and they're like, oh yeah, I'm definitely going to use this, right? So that's definitely one of the marketing tools you can use. So the reason I bring these up is that sometimes founders, before they think about how they're going to sell their product, will have a set of data or will have a set of assumptions that will actually hurt them in the process, right? So my key here is be flexible. So yeah, I see a hand up there.
Yeah.
Dave,
Yeah,
sorry,
go ahead. No, Talal, go ahead.
We are a print-on-demand platform, a marketplace, and we are starting with 15% transaction fees as a start for the first year, planning to increase that to 18% for the next years. Is that, how do you see that? I mean, increasing the percentage.
So I would probably start it at 18 and offer a first year discount.
Okay.
So you can begin to set the expectation for the customer that 18% is going to be about average, but they may get a 5% discount the first year or a 3% discount the first year because it's new. Okay. But otherwise what you're doing is setting the expectation that as the product becomes more viable, getting your initial customers to go up in price will be hard, right? Versus offering them a promo code or discount code to give them a first year discount. So what do you think your average contract value will be with those customers?
So we are a marketplace. The 15% charge is going to the printers that we are contracting with.
Yep.
So they can use our platform and print on and deliver locally in their local country. So we are charging these partners, printing partners, 15% on the top of their sales.
Right, but what do you think their initial transactions are going to be? Is it going to be $100 or $1,000 or $8,000?
$50.
50. Okay. So that'll be one of the questions as you look at how you bring on new customers is how do you bring on the high end of the new customers first, right? Because at the initial stage, how many transactions do you think they will do per year? Those $50 transactions? Will they do 3 a year or 2 a year or 10 a year?
You mean for what? Sorry.
So if I'm a buyer, I'm a business who's buying printing, and my average first transaction is going to be $50. How many
Okay.
transactions will I do a year? What's your
So the repeating customer, we are just started,
Mhm.
soft launching right now, and we did not have any repeated client yet. We just started on February, so we are not exact about the numbers there, but we can say like 3 to 4 times a year per
Okay.
customer.
So that gives you what's called a lifetime value. Let's call it 4 times a year at $50. That gives you a lifetime value of $200, right? And if you're going to be 18%, that gives you how much margin you'll make on that customer in a given year, right? So
Right.
now you can go back and calculate, like, how much does it cost me to acquire that customer? So that, going back to the previous slide, there's a cost to build the printing tool and platform, and there's a cost of acquiring a seller, right, a printer, and there's a cost of acquiring the buyer. So you need to assume both of those costs. And by the way, a good friend of mine did a print on demand company back in the early 2000s, and took it public and the whole thing. So you're definitely following a model that's already been done before, which is great. The big thing is just figuring out this is all called unit economics. So you'll see that I'll end up doing this with almost everybody, because I want to know all your assumptions on all of the numbers. I know they'll be wrong right now, and that's okay. But what I'm after is having you guys think through, like, oh, my average number of transactions a year is going to be 4, right? My cost to acquire a printer is this. And again, the early stage, they're going to be off, but at least having a thesis on what the numbers are. So for example, you may find that small businesses are super tough to sell to. And if you're going to go acquire businesses, you want to go acquire larger businesses, because they'll do 5 transactions a year at $200 a transaction. And a $2,500 a year first year customer is way different than a $200 a year first year customer. So
Right.
your sales team should focus on the bigger transactions, right? And right now, by sales team, I mean you, right? Because that's the way it is for all of us when we're starting. So this is a great example of unit economics as a set of numbers. So, all right, did I see one more hand there, or it went down? Omar, did you get your question answered? Okay. All right. So this be quick on how not to make money. So how to monetize your startup. What are the revenue models? So we talked about yesterday in the Venn. There's the business model is made up of 3 big components. There's the creating value, which is your product or your service. There's the delivering value, which is pricing, marketing, sales, and monetization. And then there's what's left over, which is your profit, your gross margin. So the revenue models, I'm going to break down for you what the 14 revenue models are. So as background, so the why I got to this number was somebody a few years ago asked me for a copy of my financial model, which I'm going to give you guys a copy of 4 templates today that you can use to build out your own financial models. In the time that you have between now and selection committee, you won't be able to get one built out unless you kind of already have some of your numbers figured out, and that's okay. They're not expecting you to have a hockey stick chart, right, in the selection committee. If you have one, all the better. Like, that'll differentiate you between you and other folks who are at the early stage. But somebody came to me and said, hey, can I have your financial model? And it was very much like the one we were just talking about with the marketplace. Mine was a subscription business that was B2B. Theirs was a marketplace business, which was B2C. And the question was, they share a lot of common features, but they're different. So in that case, what I started to ask the question was, how many financial templates would you actually have to do to be able to cover 80% of the startup market? So at the time, I reached out to the TechCrunch CEO, who's no longer there, but it was before they had their API, and asked him to run a report for me of every seed round funded company in the prior 18 months. So it ends up that was 2,654 companies. So we then started to build out, my son was in college and he was my project manager on the project. We hired an offshore team in India, and we basically went through and looked at 2,654 websites and figured out which revenue models did they use. So the team would look at their pricing page and product page, and if they couldn't see any information about how to buy, I would reach out to the CEO of the company with the email that said basically, hey, we're doing this research project. I see that you don't have a pricing model. How do I buy your product? Are you a subscription? Are you a marketplace? Are you a transaction fee? So we basically figured out all 2,654, and it ended up there were 14. So there was the other thing that was interesting about the process that I didn't expect was the fact that there was more combination models than I expected. So for example, people who did both services and product both, right? I expected them to be more like, oh, we do subscriptions, we do this, we do that. So in that case, I was surprised by the number of combination models. So the 14 you'll see here today are roughly listed in order of complexity, right? And some of the models only work at scale, like advertising we talked about yesterday. And some of the models work at launch. So I'll walk you through which ones work at what stage. And I'll also walk you through what the revenue multiple is if you were to go and sell the company. So if you were to call me in a year and say, hey, we've got our company's grown, we want to go sell the company. The big question that founders always ask is, how much is it worth? And the answer is, it's a combination of factors, right? So market comparables like buying a house, growth percentages, and then your revenue model is a big driver. So for example, subscription is way better than services. The other thing we did was we went back and looked at the companies who failed. And almost, I would say 85% of the companies that failed, and keep in mind, all of them had raised a seed round of funding. So of the ones who had failed, we went back and looked at, like the Wayback Machine we showed yesterday. We went back and looked at the Wayback Machine and basically looked at that and said, what was their last cached page and what do we know about their pricing and how they sell based on that last cached page? And 85% of them didn't have a call to action. So they had something like, call us for pricing, right? And it's seldom that your product is so rare that you're the only provider of it, right? So on print on demand, for example, that's not, Talal's products isn't the only place to buy. So a call to buy or call for more information was basically a lack of call to action. There was nothing the customer could actually do and transact. So one of the things I'll push you to is, even if your pricing is wrong, I would rather have it be up there and be public so that customers can respond to it than not be public. Now, do you want to do all of your pricing public? Not necessarily, and we'll get to pricing here after the break. But the key here is that if the customer can't take action, you're putting up friction that will be difficult to overcome to make the business successful. So that's one piece of the failure statistics. So the other thing we did is we mapped out and we tracked from seed round of funding to A round of funding, and from A round of funding to B round of funding, and we plotted out where the companies were and how long it took them to mature based on those models. And I'll pull one of those slides here from a different deck to show you that here in a bit too. So it started off kind of innocent enough where it was really just, hey, can I have your financial model? And turned into a 6-year longitudinal study of 2,650 companies, which was kind of crazy. But I'm kind of a data geek. So for me, it was a way to look at it and go like, what's the likelihood of success for these companies? Mohammed?
Dave, are you going to address whether we should put the prices online or not?
We'll talk about that in the pricing section after the break, Mohammed. I think that one of the big things is, how do you get customers, if they're there in the traffic on your site, how do you get them to engage with you in at least a on-ramp product, to Hassan's point, a time-based trial, to basically give you some information to have them be like, yeah, we're interested in that. Now, not all products can be sold without a salesperson. So you don't necessarily have to show all of your product pricing, but you're probably going to have to show some of it, right? To get people to look at it and go like, should I ask for more information or not? right? But if it's all a mystery, if it's 100% pricing mystery, that's always a challenge too. So, and we'll talk again about that after the break. Okay, so let me go through the 14 models. Your goal here is to pick your primary and secondary model. And when I get through explaining the 14, I'll give you a slide that gives you all 14 to go by as well. But know for now that what I want you to do is get some basics and go like, oh, we're a marketplace. This is how we're going to monetize. So in where this will be used on your slide deck is in your introduction, right? This is how we make money. And in your explanation of both your financial model and your go-to-market strategy, it'll be important to basically choose a financial model. By the way, if you have discovered a 15th model, great. I'm not limited on the 14. I'm just giving you the data that I've seen and obviously spent too much time tracking over the last 7 years. So if you have a new model, cool. And we'll talk about the trends in some of the models that have changed over that 6 years too. So first one is services and fee for service. So think of this as consulting, could be a restaurant if you're doing business to consumer, but services are, consulting is a great example. It works in B2B and B2C, where someone is actually selling you their time at a markup. So the key metrics in this one is the project-based revenue. If it's project versus a time-based, right? So a lawyer, for example, bills in 6-minute increments, at least in the US. Your cost of delivering, which is usually my cost of time. So if you think about this as bill rate and pay rate. So if I hire Hassan to do work for me to find tender offers, I may pay him $50 an hour, but bill him out at $100 an hour to the client. So I have a 50% gross margin on those services. The challenge with the services business is they intrinsically don't scale, right? They're good to bootstrap. So you can get the company launched. The problem is that it's hard to make money when you sleep, right? And as you add more customers, the small business dilemma is you have to add 3 new customers to hire another new person, because 1 new customer will just mean you don't have enough revenue to hire. We have to work harder, right? So Nasir and I are already working hard. We bring on 1 new customer or more. We're like, are you going to take that customer or am I going to take it? Or if we hire somebody, we need 3 new customers, right, to do that work. So typically these margins are 35 to 50% gross margins. So again, bill rate, pay rate differential is how you calculate that. So if I pay Dave $50 an hour, but I bill him out at $100 an hour, if the margins are too high and disproportionate, right? So if I pay Dave 50, but I bill the customer 200, the odds are that Dave's going to find a way to do that business himself, right? So the intrinsic value of the services business is it's easier to bootstrap, but the gross margins are lower. And it's not necessarily a bad business. It can be a great lifestyle business, but it's not something that's easy to scale, right? So because you have expertise. So so that's number 1, fee for service. So it's okay to have a portion of your revenue being fee for service, but you just don't want all of it being fee for service. So the next one is commerce. Commerce is Amazon, or the B2B version was Amazon Supply. Now it's just Amazon again. So it works both B2B and B2C. You can sell your products or somebody else's products. It can be a physical product or a virtual product. My key metrics are I have a wholesale cost of goods sold. So if I'm selling phone cases, my cost of goods sold may be $15 and my average selling price may be $30. So I have a 50% gross margin or 100% markup. So what I'm then looking for is back to the question we were talking about on print on demand is I have a basket cost. So my average transaction is $50 or it could be $500 or $5,000. In the case of the wholesale example, I have an average gross margin on that basket. So 10%, 15%, 1.5%, whatever that margin is. And the market will tell you what's the average margin, right? Because there's competitive products out there. In the case of the guys that are doing gamification for schools, there may not be a competitive product, but there is a cost the market will bear. So what you're figuring out if you're selling them a product in the case of commerce is how much can I charge for that product and what's that gross margin? So again, works physical goods, virtual goods. It's the most common one out there. On average, to go back to your exit multiple, a services business will sell for 1x revenue. So if Nasir and I do $1 million a year consulting business, it's going to sell roughly for $1 million. If we do $1 million a year commerce business, it's going to sell between $3 and $4 million. So again, I'm selling product now instead of time. So that's the average on the commerce business. So next one is subscription. Many of you will use the subscription fee to do this. So Salesforce, Box, Spotify are examples on both B2B and B2C. So your key metrics here are your average revenue per user. So so what are they going to pay me on a monthly or annual basis? Is it $20 a month or is it $200 a month? So that's called ARPU, average revenue per user. And we'll get into these marketing terms here in the marketing section as well. My conversion rate. So for example, how many in Hassan's question of time-based trial, how many people came to the site, how many started a time-based trial, and then what percentage of those converted to a monthly subscription fee. And then lifetime value, LTV, is calculated at 12 months to start. So if my monthly transaction fee is $100, my lifetime value is going to be $1,200. It's going to be the starting point. Should you calculate your LTV longer than 12 months to start? The answer is not to start. When you have real data, you can go to more longer term, but in the initial days, you really have to focus on how much time do what can I estimate today? If you calculate the number too high, then you're willing to spend more money on cost of customer acquisition, which will price your margins out, right? So you have to start off. For example, you can't do 3 or 4 years. So you have to start off with. We'll start off with 12 months, and as soon as we have 18 months of real data, we'll calculate it at 18 months or 24 months. So if you have historic data, great. If you don't, you're going to calculate it at 12. The challenge with some of the subscription ones is you can't de-feature a product, right, and have it be viable. So you really need to have a killer product that people really love and is super sticky. So your first version of the product may be a little meh, right? So to really charge a higher subscription price, you'll have to look at it and go like, what do we really need to add from a feature set so that we can charge more money? So, and that'll get to the product roadmap that we talk about tomorrow. Like at some point we need to release this new feature so we can increase the price. Okay. It's a great multiple on the business. So these companies sell on average from, if it's a niche company, it'll sell 4 times revenues. If it's a broad opportunity or broad-based product, it could sell 12 times revenues. So $1 million revenue company in this case would sell for 4 to 12 times revenues, or $4 to $12 million. So one of the transactions we're working on right now, the company's super niche, like the market they serve is very niche, but it's a $2.5 million company that's going to sell for $13 million, right? So I'll give you an example of what the difference in that recurring revenue. Now, these can be annual recurring revenue with annual contract values, or it can be broken down to monthly. The reason most of these companies talk about MRR, or monthly recurring revenue, is it's the truest form of measurement. Right. So I know what my annual contract value may be a 12-month or 24-month contract, but I break it down to monthly recurring revenue. And so the other thing I need to look at in this one from a key metrics perspective is churn. So early days, my churn is going to be higher. Later days, my churn will be less. So I may have 2% churn per month, which isn't bad, but 24% of your customers turnover in that 12-month period, which is substantial, right? So churn is kind of the silent killer of the business. So you need to be aware of the customers that come on, how many churn off. And are they churning off because the product is bad or because the product's not offering everything they need? So you'll start to track churn as well. So know that that's part of the key metrics for the subscription business. So that's the subscription business. So number 4 is metered service. Metered service is one of the new business models that came up over the 6-year span that we tracked. So think Twilio, Splunk, Amazon Web Services, Azure are all examples of metered services. So it typically starts with a subscription, and then as the number of users go up, then I can charge more for it. Go ahead, Samir.
Yes, sorry to interrupt. You're
Yeah,
talking
no
about
worries.
subscription churn. So you mean when we say subscription churn, it's the number of users who don't pay anymore, who unsubscribe from the service?
Yep. So for example, in your case, if you sold a venue and you track your revenue as revenue per pitch, right? The question is, in that year, how many companies would say, we're not going to use it anymore? Is that 5%, 10%, 50%? So early days when you're at an MVP and you have minimum viable product, your churn will be higher because the product is not as sticky, right? Some people aren't used to using it. Versus as the product matures, the churn will go down because people are used to actually buying the product and watching the videos and seeing the highlights, right, in your case. So early days, your churn will tend to be higher. So as you forecast this in your financial model, the question is of the ones who buy that first year, do I sell them an annual contract and take all my money up front? Or do I sell them a monthly contract, right? Or it could be monthly payments on an annual contract, both, right? So that's the churn number. So going back, did that answer your question?
Yes, great. Thank you. Just making sure. So in our financial model should make sure that the yearly growth is higher than the yearly churn obviously, otherwise we'll be losing money each year.
You're totally spot on, right? So the question is how do you, and then for you, it's how do you upsell? So that even though I have the equipment installed in the pitch, how many games a month or how many games a week, right, are going to be using the product, right? So that'll be one of your early key metrics. And we'll talk about key metrics with the teams after the coffee break. Okay. So going back to metered service may be something the team that's using doing gamification for students, right? You may have a subscription based on this school, and then as your user base goes up, you charge slightly more on a per user basis, right? But your initial subscription may include 100 students, and then as the number of students go up, you charge more for it. So that's very much the way Twilio or Splunk or AWS works, right? The more the customers use it, the more the price goes up. So know that that's kind of the thing that's behind it. This is historically very B2B oriented for metered service. And the only B2C example I've come up with is your cell phone carriers, right? Where you pay more as you use more minutes. But that's not generally a positive experience, right? On the B2B side, if my usage goes up, it's because the students went up, or my AWS budget goes up, it's because the server load went up because my customers used more. So it's usually more of a positive association than like the cell phone example is a negative association. So that's metered service. Okay. Transaction fee and rental have the same key metrics. They're slightly different businesses, but they have the same key metrics. So in the transaction fee example, so almost all marketplaces have transaction fees, and we'll talk about marketplaces separately. But think in terms of this as like companies like Chegg is a textbook rental company, right? So the transaction fee business, typically you're not booking the top revenue. So in the case of the wholesale example that we talked about earlier as the session started, I'm not carrying inventory or product. I'm simply connecting the buyers and sellers, and I'm making a transaction fee on the sale. But if it's a $10,000 transaction, I'm just making the commission, right? So typically in the transaction fee model, if you're not booking the top line revenue, you can use the transaction fee template. The 3 other templates, you're actually booking top line revenue. So the difference there is the revenue in the wholesale business, I'm really just booking the transaction fee. It works both business to business and business to consumer. Your key metrics here in this one are average transaction revenue, the dollar amount, the fee for the transaction, so the 1.5% for the wholesale fee, for example, and then the number of transactions per month and per year are the key metrics I'm looking at. So those will be the important metrics for you to matter. The challenges are margins are going to be low, right, on the transaction fee business. So you just don't want to start too low. So as we talked about earlier in the session. So if you have the option, you want to start as high as possible. Again, discount the first year rather than start too low and then have it be a struggle to actually make money in the business. But you'll be able to calculate that in your financial model as well. So that's the transaction fee or rental business. All right, number 6, then we'll pick up some momentum because some of these get into models that are difficult to do at launch. So productize the services, number 6. So it's very much like the services business, but instead of a customer buying consulting on the hour, the customer is buying a product or a SKU. So their perception is they're buying a solution, but there's some in the background, there's people that are responsible for delivering that. So I'm actually on the board of a company. It's the longest thing I've ever done, actually. I've been on their board for 18 years. And it's about a $30 million a year company that does this. So they're in the productize a service business. So in the US, we have a strange tax law that if I have an investment fund, my savings account for retirement, I can roll that over and buy my own business or invest in my own business. But if I don't do it well, I have to pay taxes and fees on that money. So what Guidant Financial does is they've made that process super easy and transparent. So, but they sell it for $5,500 is the price point. If you knew the right attorney and you knew the right accountant to do the services, they could do that services work for you. So in the background, there are people delivering these services, but the customer doesn't care, right, of how it's actually delivered. So the nice thing about productize the service is it's a great way to bootstrap a company. So if you have difficulty raising capital, productize the service or services may be a way for you to start a business anyway. The multiples here aren't great. They're better than the services business. So instead of 1x revenues, it's on average 2x revenues, but the multiple isn't great. So in the case of Guidant, one of the things we're doing now is we're making them more into a technology business. So part of their revenue is recurring revenue software subscription versus 100% of their revenue being services business. So that's kind of the shift in the business. So how do we sell it? When we go to sell the business, it's really about how do we drive more revenue to the subscription side of the business and the technology play. So that's productize a service. A lot of companies will start off selling services and then build tools as they go, or what's called non-recurring engineering. So I have one big customer and they pay me to build this custom product, but then I'm going to use the custom product to launch an actual software product later. So which isn't unusual. So that's the productize a service. Any questions about the first 6 so far before I start picking up some speed on the others? Okay. So next one is combinations. So I have services plus subscription, or I have transaction fee plus subscription if I'm a marketplace. And we'll talk about marketplaces next. So combinations models here are really just focused on, do I take 2 or 3 different pieces in my primary revenue model? An example in Seattle, there's a company called Smartsheet. Smartsheet is basically has built a version of Excel for everything. You know how you use Excel for stuff you shouldn't use Excel for, like project planning and checklists and things like that. So what Smartsheet does is they built a custom hosted product that they built from the ground up to do all the stuff that doesn't involve calculation. So the company is publicly traded now. They're about, I think they're a $13 billion market cap company. But 25% of their revenue comes from professional services. And the reason is that if for an enterprise to start their product, everybody has to be trained on their product. And training then became friction to actually selling the product. So they implemented professional services to shorten the sales cycle. So that's really the combination model that they use. So that's an example of combinations. So in marketplaces, your combination, I should switch these two slides around in order, makes more sense. But in marketplaces, the trend we see right now in marketplaces is I still get a transaction fee, but I have a pay to post fee or a pay to post subscription as well. So that's one of the things you'll see is that how do I drive more recurring revenue is one of the objectives that combinations are trying to drive as well. All right, marketplaces are next. So eBay, Alibaba are examples. That happens in both B2B and B2C. These businesses on the public traded comps trade for about 2 times revenue. On the private side, trade for 2 to 4 times revenue. So if I do $1 million business in a marketplace, it's going to be worth between $2 and $4 million in enterprise value. So my key metrics here are average transaction amount, the number of monthly transactions, and the commission on the transaction fee. So the critical thing here is that, you know, as you think of B2B or B2C or B2B2C, I would encourage you to keep it the smallest number of sides possible to start, right? So a two-sided marketplace is easier than a B2B2C or a C2C. So just know that the fewer sides you have at scale, you can do both, right? Or all, but at launch, it's harder. So you just need to know that at launch, that's a challenge. So that's number 8, marketplaces. So we talked yesterday about you're building an app for financial services and doing referrals. So the revenue model on that one is called lead gen. So mint.com was an example of that. So basically what you're doing is I can acquire banking customers cheaper than the bank can do it. And because I can do that, I can sell them that lead, or they can pay me for a referral fee if they set up a credit card. So that's the lead gen business. The lead gen business has historically followed Google AdWords spend. So where Google has huge marketing spend from buyers on AdWords for things like mortgages and life insurance and health insurance. So it's traditionally followed its way down market against the average spend on advertising. So some examples there, it's a super competitive business, but you have to just be better at marketing than the big companies are. Okay. All right, so we'll pick up some speed from here because they get a little bit more obscure and tend to be ones that work now at scale, but not at launch. Gamification in games. So gaming is different than gamification, but the gaming model, if you guys ever played Candy Crush, I had a friend who sold his company to King. This is not about solving a problem, it's about fun. So did I build a product that's super sticky and is it fun to use? So I don't think any of you are selling virtual swords, but the margins in virtual swords are amazing, right? So the key here is from a gaming perspective, that's actually a big plus. So your key metrics here are the number of downloads, the percentage of people who play, the average in-app purchase. So the shift here has gone from pay to download to pay to play. The irony of it to me as a user is we would normally look at a product and say, we want to take friction out. In gaming, they actually introduce friction, so you will pay to upgrade, right? So it's the only model that actually intentionally frustrates their customers, so the customer will pay. So Abdullah's laughing. So it's totally the case, right? And it's frankly the only case in business where you're like, let's make our customer frustrated so they'll give us money. If you can find a way to do that in B2B, tell me about it if you discover it. Yeah.
For a company like this, how would they create a problem slide for their deck, for example? It's
just a fun slide. So, I mean, the only problem they solve, so the friend of mine who sold his company, they sold it for $150 million. It was a ridiculous number, right? It's like the movie business. You're building hits, right? So in his case he's like, our problem slide is boredom. That's the only problem we solve. So
true.
But you have to over-index on fun, right? Because if you build a game and it's not fun, the answer is you're toast. So because no one cares. So with gaming, one of the key indicators there is 21-day usage pattern. If people still use it at 21 days, you have a winner. If people don't use it at 21 days, you don't have a winner. So yeah, very hit driven as a business. So that's number 10, gaming. All right, number 11, advertising and search. I mentioned this one yesterday. If I monetized my site today by 3,000 to 5,000 monthly users at an average CPM rate of $35, I would make $100 a month. So is it a legitimate model to do advertising? Yes. If you talk about doing advertising as your revenue model, the question will be from the selection committee is how are you going to survive until you get to 1 million unique users a month? So just know that that's the question they'll be asking. Is it a legitimate model? Of course, Google makes huge money, right? Facebook makes huge money. So your key metrics here are traffic, percentage of clicks, and average revenue per click. So that's the key metrics. So again, scale is the thing that matters on this one. It's completely doable. So number 12 is called new media. So this is an example of Snapchat and WhatsApp. So this is probably the revenue model that doesn't really need to be a revenue model. The idea with this one is our customer growth is so fast of going up and to the right that we know we're going to monetize it later through advertising. So Pinterest, WhatsApp, Snapchat, Facebook in the early days, Instagram, all had a viral coefficient. So you'll hear this called going viral, which ironically a year ago was hard to explain, and now everybody understands tragically too well, right? So it's for every paid user I get, how many follow-on users will I get with that? If the number is greater than 2, I have a viral winner. If the number is less than 2, it's just okay, right? So the difference here is it's only B2C, not B2B. So the one exception I will tell you historically is LinkedIn. So at one point, LinkedIn had introduced a tool where you could upload your entire contacts list. And for a season of about 18 months, they had a viral coefficient of greater than 2. But it spiked and went back down. So today they get, so think of this as 3 levels of K factor of virality. One is word of mouth. So B2B typically gets word of mouth. But if I find a competitive advantage in my business, I'm not going to tell my competitors about it, right? So I get word of mouth is number 1. Network effects is number 2, which is, does my product work better when I have more people on the platform? So if I invite my friends to it, WhatsApp, does the product work better? So that's a network effect. And then the top one is going viral. So again, this is one of those that every once in a while I run into somebody who's like, we're going to go viral. We're going to get listed on TechCrunch and people will download our app. And I'm like, you're B2B. Like B2B companies don't go viral. So, and if you're the first one, send me the data. I can help you calculate it. It's not that hard, but I've yet to see one. And I would definitely write a check for that one. That would be kind of crazy as an investor. So if your plan was launch your product and go viral, that's what somebody means when they say it, but it's hard to do. All right, 13 is big data. So Patients Like Me is an example of that. So the challenge with the big data model is you have to have the data in order to sell the data. And it typically takes longer to do it. So we had a company in the last venture fund I worked for in Portfolio 1 that decided they wanted to shift from subscription to big data. And I was talking with them about their plans to do that. And the answer was, great, you can definitely do that. My question for them was, what are you gonna do in the 18 months while you build the data? Because you're not gonna make any money. And they hadn't thought that part through, right? So the key here is that if you have the data, so in the case of Muhammad having the data on pearls, right? If you have the data, you can sell it. If you're building the data, you're not going to make any money in the near term. It only works at scale. So the question is, what do you do in the meantime? Do you sell subscription, right? Do you sell services? How do you make money so the company survives? So your key metric here is how many API calls are made. So is application protocol interface is what API stands for. If you think about this one, it's basically, if you're familiar with the concept of banking as a service. So there's a company in the US called Plaid, and Plaid connects all of your financial services and accounts, right? So the way they charge is based on how many API calls were done to the server, which if you're geeky is kind of interesting and easy to calculate. If you're a consumer, the answer is it just doesn't work, right? So big data is a B2B play, not a B2C play. How many, what do you charge per records and how many records do you have? So that'll be one of some of the key metrics. And you'll need to have the data in advance or a path to the data. Anybody who's doing something in AI or in machine learning, this is an example of how you charge for it after you get this subscription basis. Okay, so number 13. 14 is the last one, and I'll give you a list of the 14 in total. So you can pick your primary and secondary. So licensing still is a valuable model, but 15 years ago, I remember, so my first company was in the Microsoft licensing space. So we did, it was called License Online was the name of the company. We did software licensing. So 15 years ago, Microsoft was like, we don't know if we can charge subscription versus charging for a license. And now they've made the shift completely, right? But their original business was they sold through distributors, right? Because it was a packaged good. So instead of them having millions and millions of people paying them directly, they had 5 distributors in the US who did all of the business with Microsoft, and you couldn't buy direct from Microsoft. You had to buy through the distribution partners. So they've since shifted that business completely, and now you pay $10.99 per month to buy a monthly subscription to Microsoft Office. Almost all software has switched to subscription, but licensing still works, right? So licensing is a model that you can still do. It's just simply a question of, for example, the most common use case is to license for a field of use. So you have somebody else's technology, you want to license for MENA. Great, that's the licensing model. So, yep, just like Adobe is comment. So you can still do a one-off purchase of Microsoft licenses, by the way, but most people just buy the subscription. So that's the licensing model. So those are the 14. Here's your mission, is pick your primary and secondary model. And you may only say, well, we're only going to use one. Great. I just want you to pick a primary and secondary. So if the first one doesn't work out, you know which one you're going to try next. So the question about one-off purchase. So one-off purchase may be commerce, if it's a single one. A license was the example there in Microsoft's original was it wasn't commerce. You bought a perpetual license. But typically when somebody upgraded the machines, they would leave that license behind, even though they could have taken the license with them. But most people didn't do that. The breakage on that was the amount of people who didn't take that license with them in their upgrade was a huge percentage of Microsoft's business, by the way. So, but a one-off purchase would typically be commerce.
Hello.
Yeah, go ahead.
What about if we use a hybrid business model? I mean, using more than one at the same time.
Yeah, that would just be a combination model. Totally okay.
Yeah.
The question is, which one are you going to use in tandem? I still want you to have a primary and secondary, and you may both use them both at the same time, which is totally okay. But again, I want you to have a primary and a secondary.
Dave?
Yeah.
Can I go?
Yeah, go
okay.
for it.
Our subscription is sort of a licensing, an annual license for schools. And then it's sort of metered because, you know, the number of students determine what you pay, but then after a certain period. So you can keep onboarding more students. And then after the year, the software reads and sees how many more students you have and if you need to pay more. Now we're saying if you have less students, as it grows, you pay for less. And I think we have a premium for if you have less than the required number. If you do not have up to 50, for example, you know, you don't get to pay anything. If you reach 50, you pay us X amount of dollar. That's tiered. Like, you know, we've made the pricing like that. And then if your students reach, let's say 150, then you pay the next tier. You know,
Great.
So we have a subscription that is based on license. And then why we did the licensing is so we could give others to do the Microsoft reseller program like you talked about. I think I know about the distributorship and then the authorized education reseller, which are sub-distributor to actually reach the more schools. Because there are a lot of schools in, let's say, the sub-Saharan Africa, how many with about 58 million students. You know, in Nigeria alone, in private schools, there are about 36,000 of them. You know, how do we reach that? So the idea was to do the licensing, and then there's fee
So let me
for a
break
service.
down the pieces there for everybody else so they understand some of the differences. So you have basically a subscription business with a metered service is your primary mechanics. The freemium that you mentioned is a marketing tool, not a pricing or revenue model. So freemium is a marketing mechanic, right? So it says if you have less than 50, it's free. But when you go above 50, you're going to pay a subscription. And when that 50 goes to 150, you're going to pay a metered service as the usage goes up. So the reason I want to break that down, I know you know this, but the reason I want to break it down for others is sometimes people will say, oh, my revenue model is freemium. And I'm like, that's not a revenue model. That's a marketing mechanic, right? And you may decide to change that and do time-based, right? But there's lots of marketing mechanics, and marketing is a wildly creative enterprise where revenue models are pretty predictable. Like these have not changed very much in the 6-7 years that I've been looking at them. So I'm going to give you the examples now of the changes. So at the beginning of this, you guys remember the Groupon, the company? Okay. So at the beginning of this, Groupon was this new model that ultimately became commerce and lead gen. Do you remember how many copycats of Groupon there were? Thousands. So what's interesting here is revenue models are not defensible. They're public domain, right? What the cool thing about it is if there is a new one, you can copycat it super fast, right? The bad news is they're not defensible. So Groupon was one of the unique ones when we started looking at the data that ultimately just became commerce and lead gen. The other one that happened as we were looking at the data initially was coins and tokens. Coins and tokens ended up being a financing model, not a revenue model, because there's no metrics. So if you think about, you're going to track key metrics of your revenue model. So in your case, Abdullah, it's like how many freemium trials per month? Of those freemium trials, how many converted to paid? Of those who converted to paid, how many went to metered service? How many students so you see how that goes from like a concept of a revenue model to key metrics. Coins and tokens had no key metrics, right? It was just a financing model. So originally I started to write about it, and then it kind of was like, nah, there's actually nothing there to write about. And then metered service was the only new one that happened over that 6-year span. So AWS, Twilio, Splunk all had launched and had been successful with metered services. And not everyone qualifies for a metered service. So for example, business to consumer, if you're selling to the schools, totally works. If you're selling to consumers, probably doesn't work. So that's a good example of those are the changes we've seen over the 6-7 years we've been tracking this data set.
Dave?
Thank you.
Yeah.
How do you explain why some revenue models sell more than others? For example, subscription versus marketplace. Is it because what you just explained, or LTV?
Yeah, I think honestly, part of it's the enterprise value. Like when you go to sell a company and you can sell it for 8 times revenue, people are like, how do I make like my publisher on the book was like, can you write a 100-page book on subscriptions? I'm like, why? He's like, because there's subscriptions for everything. Like Amazon sells a subscription for vitamin water, right? They'll keep shipping you something on a recurring basis. The multiple and predictability of that revenue is so strong that almost everybody's trying to figure out, how do I shift to that multiple? And it's really about what the enterprise value of the company is. So a friend of mine runs a public company in the US that does education. They're a private, well, they're a public company, but they do private education. They're $1 billion revenue company with $1 billion market cap. But Chegg, who's a $1 billion company who rents books, is a $4 billion market cap company. So your revenue model is so indicative of your enterprise value that's why I think a lot of people have switched to subscription.
Got it. Makes sense.
Talha?
Yeah.
You're on mute.
Yep. Sorry. Yeah. So
Go
my
for it.
first, I have two questions. Basically, first one is giving software as a service
Mhm.
that falls under subscription, right?
Correct.
Okay. And second one is if I am having like 4 revenue models, meaning that maybe I'm wrong. Okay, meaning that I have B2C subscription, B2B subscription.
Mhm.
Then there is software service, which is also a subscription. So it's subscription. And the final one is giving educational courses in sign language. So that will be a one-time off, right?
That's probably commerce. So if I'm selling a course or a subscription
Mhm.
and I'm doing it as a transaction fee, I would sell it very much like a virtual product, right? Which is really just commerce. Now, whether you're going to want to track how many people complete it, what the percentages people are that download it, right? And you may end up giving those courses away for free because you want to move people to a subscription. So let me draw a distinction here for some of the folks who don't know software as well. Software as a service is basically a hosted cloud delivery system. Not all of those are paid. So SaaS, by its nature, is really just cloud hosted solution, whether it's free or whether you pay for it. The way you monetize it is subscription. So in your case, you have a course that you sell, right? And that course may be a single price of $20, right? Or 8 BD, whatever the number is. But I may give that course away as a subscription premium. So instead of selling it to you, I may be like, sign up for our annual subscription and you'll get the course for free. So that turns it into a marketing mechanic. So you'll have to play with that of like, how many courses do we sell versus how many subscriptions do we drive? But what you're after is on a subscription basis, what's my monthly recurring revenue associated with that subscription base?
Okay, got it. Thank you.
Yeah, of course. Monica?
Yeah, hi. So we provide white label solutions, right? So using a credit score as an API or as a solution that is white labeled for a bank. Does this fall under licensing, or does this fall into some other category then?
It's probably lead gen, right? So
Okay.
banking as a service, it depends on whether you're selling to the consumer or to the bank, right? So in the case of Mint is a good example of what you're doing is you figured out how to aggregate customers and draw new customers in for the bank, and then which bank service you want to sell them. And the bank's going to pay you a referral fee for each of those products that you sell. So that concept is lead gen. And your key there is you just have to be better at marketing than the bank is, which shouldn't be hard because banks are traditionally not very good at consumer marketing, especially
Right.
Gen X.
Actually, lead generation is our first revenue model. The second one is providing our entire algorithm to the bank so that they can white label it and market it as their own. So
that would be big data.
That would be big data. Okay.
Yeah, because you're selling it based on how many API calls are they going to make and what information. And like the guys who yesterday talked about the telecom program that sells to their target customers, how to analyze their customers.
Right.
That's a big data play as well.
Okay, awesome. Cool, thanks.
Yeah, of course. For me, this is one of those, when I meet with a startup company, I'm like, oh, so you're a marketplace that makes money on transaction fees and subscriptions. And they're like, how do you know that? And I'm like, I've just spent way too much time looking at revenue models, for God's sakes. It's horrible. So, or it makes me geeky about it anyway. Nasser, go ahead.
Yeah, so beside the licensing that Abdul talked about, like I told you yesterday, we have the tournaments, right? So the tournaments, we charge students just a one-time fee to participate in the competition, right? So where would that fall under?
So it's really just a transaction fee, right? It's a one-time fee. So, and I would probably look at that as just a marketing mechanic is, so if I'm able to acquire customers at break even, but it allows me to figure out who their school is so I can go sell to their school, I would look at that as you probably even say at some point you may consider making that, running a promotion code to make it free, because it's going to drive back B2B revenues.
Okay.
And it'll be interesting to see how it changes over time, but that's, if I had to make a guess, that would be part of my guess.
Okay. And
Wow.
so
Okay.
we also allow like third parties, for example, like an examination body can share content on the platform and charge students. For example, maybe maybe in Bahrain there's an examination body that allows students to prepare before the exam, so they can have content on our platform and charge for it for students to prepare before the exam, and we take a commission from that, so maybe like 50% commission.
Yep.
Also.
Yeah, so I would just look at that as commerce, honestly, because you're gonna look at that and say, we have the SKU, right? We make 50% margin, right? So it really is not much different than commerce. It's just a product produced by somebody else. But that's true for Amazon too, right? Some of the products they produce are their own products, and some of the products are somebody else's products.
Okay. All right.
All right. Go ahead. Who's ever's next?
I guess Monica has had her hand raised before, so Monica, go ahead.
Monica, you still have a question, or should I put your hand down?
No, I'm done. Actually, I wanted to lower my hand. Okay.
All right, you got it. Go for it.
Okay, so in our use case, we have either two directions. Since we're installing our own cameras at the court and charging a fee for every recording, we can either do it a B2B, like our meter servers for court owners. We tell them, okay, if you have this number of games per month, you can use this this tier. If it goes larger, you can pay higher. So it's either that B2B, or since we can directly charge players in a B2C model, we can make it a rental or transaction fee. So maybe in our case, we can ask ourselves which customer would be easier for us to acquire. Is it the B2B, is it the court owner, or the customer, or the actual player? So
yeah, so
that question for you to ask.
My guess is the way it will mature is because you have two things to start, right? I have hardware sales at margin or at break even, right? Which is always a question.
But we can handle the hardware from our side.
Yeah, but initially the hardware is required before you can charge a subscription and before you can charge B2B or B2C, right? So then the question is, I may charge a monthly subscription to the pitch owner, and then they could be a reseller and share in the margin because they have access to the customer, right? So the question then becomes, do I create a two-tier model, which I say, hey, pitch owner, we'll install the equipment and then we'll do it as a revenue share with you. So every time they sell the participants, they get part of the revenue because you don't have a sales force. You can go out and sell those to that many people. So that's one way to approach it, but it's probably B2B first. In fact, my observation in doing, a bunch of these at this point is almost all of them that are debating B2B and B2C start B2B because it's easier to find the list of buyers, right? And then they migrate to B2C because they have the distribution in place or they have the installs in place. So that's almost always the case. But you'll have to see as we test it, right?
Okay, thanks.
Yep.
Dave.
Yeah.
Just a couple of questions. So as you might recall, we're a talent development platform that essentially understands an employee's development needs and connects them to the right coaches, etc. So we essentially productize a service where we have a platform, we do the matchmaking between a coach and an employee, and they essentially carry on those engagements, right? We're now looking at utilizing the same service for companies to use our technology, our platform, and this matchmaking algorithm that we have for their internal coaches, internal mentors, etc. So we're moving into a subscription-based model as well. So where we get currently 30 to 40% margins with productizing a service, we then move on to an 80-90% pure play sort of SaaS model.
Yep,
Would you think that is the right segue given the stage we are at, which is bootstrapped and 6 months, 8 months in business?
Yeah, totally. Because if you can get to your monthly recurring revenue, the question then becomes as we add new features to the product, can we charge more on that monthly subscription to the business?
Yeah.
Right. So my MRR goes up.
Goes up, right. And then do we still then keep product as a service alive if we see good traction with subscription?
Maybe. I mean, the question there will be one of, do you need, because that's very much in productizing the service, it's a way to grow the business that's profitable.
Yeah.
Right. The question is, at some point, do you jump off and go straight product versus product as a service? And some businesses, that's hard because they're used to the margin is 35, 50%.
Yeah.
And they don't want to make the complete jump. So there's a company here in Seattle called SEO Moz, now just called Moz. So originally they were a consulting company that used that consulting service for search engine optimization to build a set of product tools. They use those tools internally with people, product as a service, and then eventually sold that company on the product as a service side and went straight into the tools business, right? So they made a very deliberate jump, and their multiple reflects it. But a lot of companies never make that jump because they get used to the margins on the 35 to 50% gross margin services business.
Right. Right.
So that's kind of the question is, as you look at the growth opportunity of the business, if you can really build tools that businesses can use and deploy quickly, building their own mentors inside the enterprise, then the margins there are going to be 80, 90%.
Correct. Exactly. And just one final question. We're thinking about that is more of a paper active user model rather than a paper user model. What are your thoughts on that?
So it'll be a little tougher to track. And what I mean by that is not for you to track, but it'll be tougher for the enterprise to track. And when you introduce that concept of variability in mystery into the enterprise, they typically don't like it, right? I'd rather say, well, what's it going to cost me to deploy this product? And you're like, well, it kind of depends. And for the buyer, the answer is, yikes. It's like when remember when they used to charge for per text messages for cell phones?
Right.
And you're like, how many text messages did I send? Oh my God. Right. So if you introduce that ambiguity to the customer in the enterprise, they typically don't like it. Right. But again, it's something you'll have to test. But that's my initial observation is you want to make it as forecastable and predictable as possible. And that way somebody can look at it and go like, yeah, no, we're getting great value for this versus like, we never know what we're going to get charged. Enterprise customers typically don't like that.
Super. Thanks, Dave.
Yeah, awesome. Great question. Omar?
Yeah, according to the business model I'm going for is, I know it's a marketplace. I'm kind of lost to what would be the second pick. It's similar to, I'm sure you're aware of Weebly, right? Which is recently acquired by Square.
Yep.
And because we're in between of Square and Weebly also as a subscription model, it's a POS and an online store for restaurants, because we've, as a web and mobile app agency, we have noticed that many customers struggle managing the stock because we're creating the website in a totally different system and the POS is a different system.
Yeah, I think you bring up a good point here that I haven't thought about in companies like yours where you're like, there's an existing template and a playbook we can follow. And they do subscription, like it takes the mystery out of it. A lot of the startups that I deal with, and some of you on the call, you're like, I don't really know because we don't have a copycat that we're doing. And by the way, I say copycat totally respectfully, not as a derogatory term at all. When you're following a playbook somebody's already done, the answer is follow that playbook, right? You don't need a secondary one. So that's okay. Because when you go to the selection committee, you'll be like, you've seen Weebly, this is what they do, this is what we do, this is how you need your POS and your inventory system on the same system. So consequently, we're going to monetize on a subscription basis.
Because we've been using Square like for our personal business as well. And we've seen, because Square is a regional, they have regional restrictions.
Yep.
It is not in GCC at all. They have some services, but they're not really giving everything that they offer in the US. So we've seen that this model is much needed in this region as well.
Yeah, I think that's fantastic. So it does challenge my thinking a little bit, but in a good way, right? Because if you are following somebody else's playbook, the answer is just follow the playbook. Like you don't need a secondary.
So the second pick will be the closest pick. I think would be the subscription. I think, right?
Yep, or transaction fee, depending on which one you lead with, right? So, for example, you may have a transaction fee that says, hey, if we're doing this thing for you as well, we'll charge a transaction fee versus a subscription?
Eventually it will be, because online transactions will come to, because we are also a payment gateway and we offer the lowest rates. So it's still the same.
So I would make that, and I don't think you necessarily have to offer the lowest rates because nobody else is offering rates, right? So you may not have to be the low price leader. Great book on that topic, by the way, is called The Technology Stack. It was by the co-founder of Square. I would definitely read that.
Interesting.
You guys, anybody in fintech or the financial services guys, the technology stack. Let me pull up the I think it's the tech, and maybe the innovation stack. It's the innovation stack. Hold on. The author is Jim McKelvey, and he writes about, for Square, how many little things they had to put together to build an innovation stack. So
yeah, it's like Square is like the brilliant idea they've come up with to like, according, because I lived in America, and according to the market they have and the solutions they provide, it's like the solution for them today.
Yeah, and if you read the book, he breaks down how they got to each of those solutions and built competitive advantage around it. It's a brilliant book for what you guys are doing.
Okay.
All right, so we're gonna take a 15-minute break. Thanks for enduring. Yes. Thanks for picking your primaries and secondaries. It matters a lot from the mechanics perspective of how you make money, and it'll compress your time frame. So let's take 15 minutes. We'll grab a coffee, refresh, and do whatever you need to do there. We'll see you back in 15.
Thank you, Dave.
So their best use case was customers who have 10 million subscribers. Well, a 10 million subscriber company isn't going to give a small little startup access to those big lists. So the thing that we did was we went out and said, hey, we will take your worst performing email list with up to 1 million, so 500,000 to 1 million, and give you a fixed price result on that and give you increase your open rates. So the thing that we were able to do there was a risk reversal, right? So the risk reversal was, don't give us 10 million, right? Give us 500,000 to 1 million, give us your worst performing list and we'll make it better. And if you don't like the result, you don't have to pay us. So for big companies, it took the risk, instead of the risk being on the big company, the risk was on us, right? And that was the perception. So those customers were willing to actually test the product with us. So the other thing we ran into with that company is we had Coca-Cola as one of the potential customers, and we gave Coca-Cola a proposal. And because they're Coke, right, they know that their customers are going to, or their vendors are going to raise prices on them because they're Coca-Cola. So we went out with a proposal for 1 year contract, and Coca-Cola came back and said, listen, we want a multi-year contract. And the CEO called me because he was like, what do I do? And I'm like, well, raise the price 50% and offer him a 3-year contract. So I raised the price 50%, offered him a 3-year contract, and they took it, right? So us as a startup, we're like, we tend to think about like, oh, the product's kind of come this way, and right, and it's not really as great yet as it could be. And then Coca-Cola was like, listen, we want a multi-year contract because everybody raises prices on us. So that one ended up being a great win for the company. So Nazir?
Yeah, so in our own case, with regards to the freemium, we give schools about a term to try. So and a term is like 3 to 4 months. So I wanted to know what you think of that.
I think as long as they're actively deploying the product in that time frame, sometimes if you give them too long to deploy it, they won't get engaged quickly and start to ramp up. So I would look for what are the early indicators that they're ramping up their usage, right? And then what do you do to onboard them? So like at one point, Nazir, I got a product that I paid for. And one of the things in the sign up, they said, do you want our free 7-day course, email course, right? And what it effectively did was it sent me an email every morning reminding me why I bought their product. Because, and the thing that they found is if you didn't engage with them in 7 days, the odds of you engaging with them were super low. So the question then became a question, if I have 90 days to use it as a trial, but I don't engage in the first 7 days, I'll probably forget that I signed up for the trial. So that's kind of the thing you're balancing out there in your time-based.
Okay.
Early adopter base, we talked about percentage discount. And you may want to consider grandfathering your early users. There's a certain amount of overhead implied with this. Like at some point you're like, oh, our early schools got a different price than our later schools. Over time, that can be difficult to support, right? Just because there's like I have multiple SKUs and the back office has to track it. It's a quality problem because it means you have customers, but just know that you may want to come back in and grandfather your early customers in for 2 years or 5 years or something else, versus you don't want to whipsaw the customers. You want to show new customers different pricing, but you don't want to whipsaw the existing customers. All right, I want to give you an example here. I'll switch screens. You ever have too many windows up and it's hard to see which screen you're on? All right. All right, I'm going to pull up HubSpot here as an example. So HubSpot, you'll see here, HubSpot's a CRM product. It's great for startups that compete with Salesforce. You'll see here they have a very robust pricing page. So they have products and plans, they have bundles, they have CRM, they have marketing, they have customer service. So they have a lot of products, right? And you'll see here, here's their bundled product offering, $45 a month or $400 billed annually, starts at $50. So lots of pricing options. So I just want to use this as an example. When you look at your competitors for pricing, this is the Wayback Machine we talked about yesterday. I'm going to go back here to a time in, let's pull up a time in 2012. So here's 9 years ago. And it'll show me my cached page. Okay. And here's their pricing page from 9 years ago. So the reason I bring this up, so this is not pretty, right? This looks like a table out of an Excel spreadsheet. So what they're doing with this is looking at a heat map, right? Who hovered over what thing, right? And what are my price breaks based on the number of contacts? So by comparison, here's their pricing today, right? So it's even though it's really robust, it looks much simpler. So here I have to calculate how many contacts do I have. So at one point I was like, this is super frustrating because if I import a big list of contacts that I want to market to over time, my price goes up from $1,800 a month to $3,000 a month because my number of contacts went up, but my revenue may not have gone up as a business, right? So the reason I bring this up is you can literally go back and look at all of your competitor pricing for different dates and times, and you can look at how did they position the product, what was the product offering, and what were the pricing options. So, and I would encourage you to go do that because what it'll show you is like this is a tiering mechanic, right? So based on number of users. So in Nazir's point of when I look at schools and number of users, maybe I price it based on number of users. So, but I need to make it as predictable for the customer, right? They need to look at it and go like, okay, so my price shouldn't exceed this amount, right? Because what they're trying to do is go forecast how much is this expense going to be. So you should be able to go back to your competitors and see what they've done currently with pricing and what they're doing historically with pricing. HubSpot's just a great example of they A/B test the crap out of stuff, right? Because they have lots of traffic. So this example here was a question of, I can now use a software product that tracks the heat map and I can see where people hovered over what thing and for how long. So now I know the majority of my customers are at this price point, right? Because they have this many contacts, right? Based on the traffic during that time frame. So just an example of how to use some stuff in history to help you find that. Now let me switch my screens here. All right, so that's promotions. Some common errors. We talked about setting the price too low. You see the theme there. Try not to be opaque with your pricing. Like call us for pricing. If it's a tiered solution, you may have an introduction price, or I'll use Nazir's example with the schools, up to 50 or 500 users for free, right? So it's an easy way for the customer to say like, oh, we should try it, right? Because what you're after here is how do I get the company to engage us, from there, the question then becomes, what are the logical tiers in the pricing? And if you do have an enterprise price that you don't want to publish, it could be contact us for more information. But I don't want the default position to be contact us for more information. So think of it this way. You've assigned somebody on your team to go find you a tool to help you with pricing pearls or scaling, sizing pearls. And they find your price, they find your site, but there's no pricing information. So now my job as a junior person on the team is to come back and say, well, I found something, but I don't have any pricing information. Am I going to present your solution? No. Will I call you? Probably not, unless you're my only solution. So give me a way I can engage with you early, and then I can upsell you as you go, right? So think of it as a way for how do I get the customer to say yes as fast as possible? So Mohammed, now that I picked on you.
Yes, I think consumer or customers, they don't like visiting a website without seeing a price. If I take an example in Bahrain, if you go to the second-hand car markets, there are so many Instagram accounts that offer second-hand cars, but without a price. So usually no one goes there because they know the salesman will pull your leg to pull you to the showroom. And basically that's one way to push away customers.
Yep.
I think what I've noticed in our region.
Yeah, I think that's very much the case. I think that if you think about it from the marketing mechanic that we'll spend some more time on in your go-to-market plan, the marketing mechanic you're trying to do is get people to give you some information in exchange for information, in exchange for price, in exchange for demo, right? You're trying to help them make the decision, not make the decision hard, right? And that happens all the time where it's like we make pricing hard because we typically are making pricing hard because we don't know the right price, right? So I'm trying to get you guys to do the opposite, which is embrace the fact that we don't know the price, but we're going to pick one anyway. So, because it's better to start there than to start with being opaque. Nazir?
Yeah, so we currently don't have any pricing on our page actually, because like my partner Abdul said earlier, we deal with we give schools sort of a license, right, to use the software. So we have like partners. So those partners are like the ones in charge of selling this license to the schools. So we don't have pricing as a result. So we think it's kind of too early for us to have a pricing because we think having the partners is kind of better for us because those partners will interact with the schools more than we will do with them at this early stage.
Maybe, right? The other option is you may decide that in posting prices, the schools give you more information faster, right? Okay. So I would encourage you just to test it. And again, you don't have to leave pricing up permanently. You can bring pricing up and bring the pricing page down, okay, right? You can buy traffic to what's called a squeeze page, right? Where you're sending traffic to a specific, think of it as the Amazon checkout page, right? There's no other navigation on the page. There's just a chance to buy or sign up for a demo, right? But the question is, how do you make it, like, I have a friend who has a product that she's come up with that creates content from video. So it will take a long form video format like this, find the keywords that I use in this compared to my historic social cloud over the last year, and then create the video snippets that I can use on social media. Great, that's a super cool product. In fact, Gary Vee uses it to do all of his videos. Okay. So she's like, well, when we do a demo, our sales conversion rate is like 74%. I'm like, that's awesome. What is it if I just had a credit card and I wanted to buy it? And she's like, well, we don't allow you to do that. I'm like, oh my gosh, just test it, right? Because you may find that like, oh yeah, it converts to 74%, we do a demo. But if I created, and she has one price today, so I'm pushing her to do two prices, right? One that's designed for a consumer who just says, hey, I want to use this for my blog and my own personal social media, and one for the agencies who want to do it for big agency pricing, right? And it was just hard for her to get her head around the fact that I just want to try it for 30 days. Can't I just put my credit card in, right? And that for them was super hard. So they're testing it out now, and amazingly enough, a small percentage of the small users are like, oh, this is so much easier. And frankly, it doesn't tie up her sales resources who should be selling to bigger customers, right? So again, go out the way you're going out, but start to test the variance on it and see if schools say like, hey, for that, we'll sign up for the first 50 for free, right? Because you're just generating leads at that point.
We'll give it a try. Thank you.
Yeah, I'm big on, again, I have opinions about everything and I A/B test the crud out of stuff. And so then my opinions actually become informed opinions. So I'm big on like, just go test it. All right, so common errors, positioning as me too may not be, like somebody mentioned, hey, we're gonna be the low price leader in fees. You may not have to be. Like in your if nobody else is offering transaction fees and you're the first to market, I don't know that you need to be the low price leader, right? So don't assume even though you're new that you have to be the low price. Be cautious the same price for all customers. Like I was talking about with Kate's product, they had the one SKU they had, the one price they had was targeting agencies, right? But where social media users and power users could come in and buy it, the question is they had to really change the features slightly and then price it differently. So think about it from that perspective as well. By the way, avoid free for life. Like HubSpot offers free for life. They already are at scale and they already have customers and revenue. So their free for life really says for every person who signs up for free for life, we know we're going to convert 22% of them within 6 months to a paid program. They know that, right? Because they have data. You don't know that, and you don't have the ability to do free for life at this point. So don't offer it. All right, where to start? We've picked your primary and secondary model. You've done your competitive analysis. So one of the things I would encourage you to do next is to build your pricing hypothesis. We won't get into this level of detail with the committee, but if they ask you why you're pricing it the way you're pricing it, you should have a hypothesis, right, based on the data. You can start to do your A/B testing as you do your customer interviews using a PDF with 2 different pricing. And if you're going to do price tiers, think in terms of 3 tiers maximum. So with a recommended tier, you'll see very frequently when somebody does pricing that there's the low price, the most popular price, and the high price, and call us for price is pretty standard. So, but more than 3 tiers at this point for where you all are at are probably too much. It's just probably too many choices. So gives you a place to start with pricing. So questions about pricing, questions about if you have a playbook you're following or about market relevant, now's a good chance to do that.
Dave, so for pricing in test and B, so how different should be A from B?
It can be fairly, so the great question. So the question is, so think of it this way. I'll give you a quick mechanics, right? So I'm going to pull my price off my page for a week, 3 days, depends on how much traffic I have at the website, right? If I have 100 people who come to the site in a day, I may only pull the pricing down for a day. When somebody clicks on that price page, then I'm gonna send them to either an A page or a B page. My A page may be my historic pricing. My B page may be my test pricing, right? So that's going to be the mechanic I use to test it. I'm probably going to price somewhere between probably, if I have good data on the market, it may be a 10 to 20% price delta up or down. If I don't have good data, it may be as much as 50%. So,
Okay.
so if you don't have lots of competitors and there's not lots of options, so the testing there you want to do then is based on how much traffic do I get on the site, and then I'm gonna that traffic is going to go using unbounds. It's going to go to those A/B testing pages systematically, so you're not manually managing it, right? And then you're just going to look at what percentage of the people actually put in their information, signed up for a demo, signed up for the product, depending on what your price point is. So that's kind of the mechanics I would use, but it's based on how much traffic you get on the site on a daily, weekly. So I may pull the public pricing down for a week, right? I may pull it down for a day, depending on how much I want to cover.
Understood. So basically, with our startup, we are still trying to get the right number for pricing.
Mm-hmm.
But as I mentioned, like if people take 10 BD per hour, but We don't want to raise it up to like 50 BD per month because I'm mostly sure people won't be able to afford that. So it's a very tough for us to get the right price for the right people.
Right. Yeah, you're gonna do lots of testing, right? And you'll get lots of feedback.
Okay, thanks.
Yeah, of course. All right, Salah, I know we have a local team and I'm running a little bit late, so sorry for that. I want to give them a chance to do some Q&A with the team here as well. So, so questions as, let me see, let me bring Salah here real quick. All right, Samir, go ahead. What's your question?
Yes, please. I wanted to ask if it's possible for sometimes some situations not to have like a primary, secondary model.
For subscription,
such,
you said?
Yeah, for example, let's say, do you think it's always applicable to have two revenue models or two revenue streams for each startup?
If you have somebody you're following, it's a playbook you're following, one may be adequate, totally okay. If you don't have a playbook you're following, my only point of starting with a primary and a secondary is if you go out and test subscription and find out you're wrong, you know what you're going to do next. So that's really my intent there.
Okay, great. Thank you.
It's kind of, you're betting on where the majority of my revenue is going to come from.
Okay. Thanks for clarifying. I thought that from start you should have like subscription plus advertising. That's why. Okay.
Oh yeah, you don't have to have a combination from the start. I'm just looking for what do you think your revenue model is going to be,
and plan B just to fall back on. Okay, great.
Yep, totally the case. Thanks for the clarifier. All right. So let's see. So I pinged Salah there. If there's, I know there's a local team who's gone through Flat6 before, who's probably been waiting patiently to me to ask questions. Are you guys on the call at this point?
Yes, I am, and I learned quite a few things from you, man. Hi, Dave. How are you?
I'm great, thanks. Thanks for joining.
Absolutely.
So do you want to introduce your company to the teams?
Sure. So first off, my name is Hussein Haji. I'm the CEO and co-founder of a company called Dalluni. We were one of the first cohort companies in Flat6 Labs Bahrain. We were one of the first to actually go on and receive follow-on funding afterwards. So we're more of a gig economy / e-commerce space. Well, you want to call it social commerce, you can. We help youth get access to a source of income just simply by referring products to their friends and family. So that's our core business at the moment.
Great. Thanks, Hussein, for joining us. Give the team some example of what you thought your pricing was going to be when you launched and what you learned about your pricing today.
Sure. So we have a two-sided business. So we have a vendor panel that has a SaaS model with the point of sale solutions and whatnot, and then we have a front-facing panel which is basically for users to sell and buy product. Initially, we thought that the vendor panel would be offered completely for free, but then we realized that we were missing out on a certain revenue stream there, and it was something that we could, just like mentioned earlier, we could fall back on and ultimately do some testing with pricing certain things going forward. But when we started with the Luni, the front end, we decided that we're going to link with distributors and charge a percentage, and it's going to be a fixed percentage, 20% of each sale, so we can actually give 10% of that, so half of the amount that we're going to make on that sale for anybody that sells the product, and then retain another half. Little did we realize that the distributors themselves don't have such high margins for us to be able to charge them 20%. So we actually had to learn the hard way and sit down on the negotiating table, and then until one of them just blew up in our faces, going like, "There's no way I'm going to give you 20%. No possible way I'm going to do that. It's like, I make 5% in this. How can I give you 20%?" And that's when we started revising our pricing structure and decided that, you know what, whatever it is that we're going to charge based on category, we are going to take up 30% of that and give it to the client or to the individual that sells the product. And if somebody just buys it instead of just selling, we're going to be making the bigger cut.
So how about talk a little bit about metrics that matter? Like, what did you think you were going to measure when you first started, and what are you finding today? Or like, oh no, these are the things we really pay attention to. They're the dashboard for us.
Absolutely. So initially, our key metric that mattered was what we thought our key metric that mattered was going to be was the number of referrals and closed deals, and generally that you start to realize as you grow and as you pack up more users in the future that shouldn't be something that you're worried about. It's not always just the conversion. So our key metric that matters became multiple key metrics that matter. So we have 2 or 3 metrics that matter for us, specifically with the metrics surrounding growth. So because we have a built-in growth hack, which is the monetization of word of mouth, is what we like to say, is when people can actually refer product to each other. Even if that user does not check out and get the product, there's conversion that happens, we still manage to put our brand in front of that user. And we didn't do it ourselves, we did it with somebody that's actually subscribed with us as a sales agent to be able to make money. So the key metric that mattered for us was actually the number of carts, whether it's checked out or converted or not, it's the number of carts. And then that allows us to understand where our best market or go-to market is. And then we realized very quickly that, yes, we are in Bahrain. Yes, we have a couple of 100,000 users, but the number of carts for a smaller number of users are much higher in Saudi Arabia than they are in Bahrain. So it's definitely the market for us to focus on. So that allows us to understand where we're headed in the long run. A lot of people are very short-term focused, and very quickly you're supposed to understand that, hey, you have to think of the long term, and that's when you realize that it's not always just the conversion that matters. It's a little bit a few other things as well.
Yeah, for sure. So I'm gonna one more question, and I'm gonna open it up for questions for them. So,
sure.
Knowing what you know now, when you look back to this phase of the boot camp, what do you wish you knew then?
Just about everything. but on a serious note, I've been in this game for a while. So this is my 5th startup. I've launched 4 prior to this one. I failed in 2, successfully exited 2, and my current. I'm still learning a few things as I go. And as I was telling you earlier, and I just texted Saleh, I was like, I'm on this call and I actually learned a couple of things. Thanks for that, Dave. So you're always the thing that I think everybody should keep in mind is, hey, even if you're the CEO of a startup, even if you know your product the best among just about everybody else, doesn't necessarily mean that you know everything. So be accepting of anybody giving you advice, whether you take it or not. It's definitely something that eventually is going to work. Going to work your way, or you're going to have to come back to it one way or the other. So yeah, that's something that I wish I had way earlier. I was a bit of a, I'd rather butt heads with somebody than take it and learn. So.
Yeah, I introduced the concept yesterday to the team of strong opinions lightly held, informed by data.
Yeah.
So it's good to be strong opinions and be willing to butt heads, but hold them lightly so that as you have data and it changes your opinion, you're like, oh yeah, I should have done that faster. So
exactly, and be accepting of that. So even if you realize that, yes, I did butt heads, but eventually, hey, he was right. And you know what? Let me go tell that person, you were right. I'm sorry for butting heads. But this whole sense of pride isn't going to take you anywhere if you just continue thinking that way.
No, it's super expensive too. I agree with you.
Absolutely.
Well, let me open it up to the teams. What questions do you have for Hussein?
I think Talal has his hand raised.
Go for it.
Hello, Hussein. Nice to meet you. Actually, we are all here for funding. Sorry, for funding and take that path. So how is it like before funding your startup and after funding? I mean, what is the pressure that you had? I mean, and what is the opportunities that you are seeing? Thank you.
If you think absolutely, man. If you think funding is going to relieve pressure, then you are definitely wrong. It's not going to relieve any pressure. So if anything, it's going to increase the amount of pressure that you're going to have, specifically because you have more aggressive KPIs to achieve, and you have a limited amount of time for you to use that funding to be able to achieve those KPIs. So when we started, we were obviously not heavily funded. We had a little bit of money here and there, and we were trying to test a couple of products. We pivoted a couple of times, and it didn't start the way it is today in the beginning. So yes, it was very difficult. Yes, we didn't have the team because we couldn't afford the team. We were just two people, myself and my co-founder, and then we had one hire after receiving a small amount of funding. And I think what was very difficult for us was to wear the multiple caps. Again, it's a huge learning curve. You learn a lot of things, but wearing multiple caps is extremely stressing. As you get funding, the thing that you start doing as a CEO is you start realizing that you're more of a stakeholder manager, and then you focus on product, and you can actually give 20% of your time or 30% of your time on product because you've hired 3 or 4 people that can actually make your product better. And it's always the smarter option for you to hire somebody that's smarter than you in that domain to be able to run it and completely trusting them with it. And then you just have more of a capped role to like monitor everything if everything is working according to the vision that you have set up in the beginning. So pressure was still there. Obviously, the pressure was based on, hey, I have a ton of money that I need to spend for that. That's not my money, but I need to kind of like figure out how to take it from step 0 to 1 and make it a business that has more potential to grow. But yeah, that funding does make things easier for sure. But again, that doesn't necessarily mean the pressure is relieved. So I hope I answered the question.
Thank you so much, and very good luck. Thank you.
Thank you, man. Thank you, Talal. So 2 hands. I'm gonna go with best. Is your name iPad?
No. Yeah, no, this is one of my staff.
Oh, okay, cool.
Actually, so
no, I saw the name iPad. I was like, did someone call someone iPad? That's funny. Anyways, go on. So, I'm doing very well, thank you.
I have seen you pitching before, actually. You were amazing.
Thank you. Thank you very much. I appreciate that.
I have a question for you. You said you have a market in Bahrain and your market in Saudi is better than Bahrain.
So we're just talking about it.
Yeah. So how was your transaction from Bahrain to Saudi? Was it easy for you? Because any market in Bahrain is smaller than Saudi for the obvious reasons.
So yeah, the transition wasn't that difficult, to be honest. I mean, that's what Bahrain was selling itself for the last, I don't know, 4 or 5 years. It's the perfect launch pad for you to scale into the region. And it's true. You get to test with a group of people. So there are only 1.6 million people in Bahrain. If you manage to prove the concept with a couple of 100,000, 300,000 of that population, and you know that your brand has some sort of an established name, then you understand that the process works because we all speak the same language. We're all within the same region. I know it might differ one way or the other and very minute things, but still it's a perfect testing ground. And when you have proved it in such a small place, then you can pivot a lot without spending a ton of money. Then definitely you need to focus on scaling it outside because you're not gonna, if you want something again on the long term, it's not smart to fixate it on just one place or one location. It has to be very scalable. So our transition to Saudi happened for us. We were lucky that it happened with using exactly our platform. Our CAC is extremely low simply because people refer each other. And one referral, I'll tell you a very nice story. So there are several things that you can sell. For example, we have a coffee machine that's pretty famous on our platform for some reason. And somebody that knows another person in Saudi Arabia that wants to buy a coffee machine from Bahrain, obviously, shared a link to that individual. That individual, instead of just buying one coffee machine, had his entire family / extended family. I think he sat down in the majlis and spoke to everybody about it. And we managed to get almost 260 sales in a span of like 3 weeks. And that concept of virality and the fact that you can get one sale in Bahrain out of 1.6 million people, and then you have 30 million people in Saudi Arabia. So you can do the math here, right? Yeah. It's just the chances are that you're definitely going to get much more sales in a much bigger country. So the transition was necessary. I'm not going to tell you that we have a trade license there. We don't yet, but we're shipping a ton of product as we speak today. So I actually am in front of me right there. I see like 20 boxes to be shipped just today. So yeah.
It's not complicated because not the transition, like Bahrain, the way it is in Bahrain, And then, for example, ours is mental health app. Okay. Yeah. So for example, how we're doing the process, of course, in Saudi is it can be complicated and how they're doing it and how they.
For you, because it's mental health, you definitely have to go to the right channels of figuring out what are there certain licenses you need to to get in that region. For example, I know, let's not talk about mental health specifically. Let's talk about different types of businesses. Uber in Bahrain are not allowed to, not anybody can become an Uber driver. You have to have a registered taxi. But in Saudi Arabia, anybody can be an Uber driver. You see what I mean? So yes, certain things that you need to acquire licenses for per country, but the thing that I believe is the core aspect you need to focus on is localization. You got to make it in Arabic. You got to figure out that, hey, Saudi Arabian people are going to be like 60-70% of them don't speak proper English. I think it's a bit more than 60-70%. So they need it in Arabic. Their education was entirely in Arabic. So that's one thing you need to really focus on, localization. And then figuring out licenses is part of the journey. If it's complicated, then you just got to do it. Just lift up the sleeves and just do the hard work. That's how it's supposed to be.
When we did the survey and stuff, we started off our app with English first, then just for Bahrain at the start, Then in Bahrain, it's still like we have more expat than you can ever imagine, and it's more. We always start off everything in English more than actually in Arabic. But then we thought later we do change it. We will provide in Arabic. We are working on it to make it also in Arabic.
Bilingual.
To become bilingual. Yes.
Exactly. That's perfect. That's perfect. You got to do that. 30% of my Bahraini users are using my platform in Arabic. I can tell you that for very bluntly. So yeah, it's important for you to localize. That's why all the biggest platforms in the world today have the platform in multiple languages, not just English and that specific language, but multiple languages throughout the region, because it's all contributing to scale in the end. You want to think of how scalable your business can become, so you have to be able to localize it in multiple domains. So perfect.
What do you think if it's other than when we move from Arabic, English, and then the common, of course, language, Arabic, English, and then common like Spanish and French, مثلا, when you do the app?
Start where you are today. You're going to move to Saudi. And then obviously you have to figure out those big markets, and you got to acquire at least a certain percentage of that market, and then think of scaling internationally and going to multiple places. Don't scale everywhere from day one, because that's not smart. It's going to be too draining for you.
I have one more last question. I'm sure
there are a few people that have their hands up, Basma. So
let's go to the next. Let's go to the next question.
I think
we'll come back.
And if there's some time, we'll come back. Yeah. So I think I have Sumaya that's raised, and okay. So let's jump to Sumaya real quick. Yeah.
Hi, thank you for your time. I wanted to know more about when you talk about your pivot. So do you know, like there's this mindset that you should kind of stick to your idea and be persevering of your idea, and then there's also this like accept that sometimes you will have to pivot. So I wanted to know like what specifically made you consider the pivot. Was it data? Was it like user feedback? What was it that made you pivot?
Okay, so when we started the company, it was called Integrab. So Integrab was a data analytics tool. We helped retailers understand where to scale and sell their products internationally just by providing the data. I had the day we decided to pivot is when I had met a couple of local companies, big companies here, to work with them on a third-party agreement to offer the solution to their clients. They came to us and said, we'd love to, but we have a shortage in our sales teams. And my response was, why do you have a shortage? You're a company that pays dividends twice a year. You're profitable. There are so many people that require jobs. Their response would rather not bear the liability of paying salaries. And that annoyed me as an entrepreneur. Why on earth would you call people liabilities without giving them a chance? So I sat down with them and found out that they'd rather advertise. So I then did the research with my co-founder. We found out that there is this massive opportunity, and we can utilize data that we've already collected and we're continuously collecting to be able to enhance our product and offer it even further, to connect those people that require those jobs with those businesses, to be able to do something together without having to waste money on advertising. And that's when we realized we needed to pivot. We saw this opportunity, and we saw that we have something that we could put inside the core product and utilize it as part of a bigger platform, and we did it. Now, pivoting doesn't necessarily mean you have to use what you had initially. You could start by trying to sell, trying to be an e-commerce portal, and then ultimately becoming a solution provider for something completely different. It doesn't matter. But the whole thing is that you need to be accepting of the fact that it's not you that defines the market, it's the market that defines you. And if you want to really change that market yourself, you're gonna have that unbelievable financial backing, massive, customer database, unbelievable, unique selling point, something that nobody else has thought of, which is virtually impossible in the world today. So you got to be able to understand that it is the market that defines your product. If you don't have a customer for the, and you've been trying to acquire one customer for the company in the last year, you should pivot. You should change. You should change what you're trying to do or you're offering, in a sense. So yeah.
Thank you.
Any other? Absolutely. Anyone else? All right, so we're going to go back to.
Hey, Hussein, just one last question.
Devesh, please, Devesh, go on.
Yeah. So how do you know when the market timing is right? So what are the telltale signs before you enter the market? Because obviously, the market timing is not right once you've gone through that whole cycle and known that, to your point, like if you just sold one product, then it's not working out. But how do you understand whether market timing is right for Daluni, for example?
Many people think that because I'm facing the problem, I'm going to launch a product and everybody else is facing the same problem. And that's not true. That's not true. It's not just because you are. You got to be able to do some extensive research in that domain. You got to be able to do, as much as I hate surveys, but you got to survey. Even though like 80% of those surveys, the data from survey could be, not real, or just somebody trying to just finalize a sheet just for the sake of giving you some sort of support. But then you got to be able to do more research and understand a bit further. And it's always an opportunity. Finding the right timing for you to launch a product is one of the most difficult things, because you never know when is the correct time. The only way for you to find out if it's the correct time is when you actually launch that MVP. That's why pivoting is necessary and crucial. It's because when you launch that MVP and you realize that, oh my God, all my readings are wrong, let me think of something else. Let me pivot to something else. Maybe out of the 10 things I'm offering, only 2 things are working. So let me just throw 8 away and focus on those 2 things and shift my entire business model into something that works. So you can't, there's no such thing as fortune telling, unless you're like this unbelievably smart hedge fund manager and you know where to throw your money in. Besides that, it's very difficult. So.
Thanks.
All right, time for one more and then we're gonna go to lunch break.
Anybody else? I think the guys from the mental health company had another question, and we're gonna go away afterwards. Oh, Naqib. Yeah. Go on.
Yes, all right. So how do we address the situation when you know that one of your competitors who is not yet into the area that you are venturing is able to launch a similar product which you are trying to enter in less time, because they have much more bigger team and much more funding, they are much deeper into the market?
I'll tell you a story.
Yeah,
I'll tell you a story. You know Airbnb. Everybody knows Airbnb, right?
Yeah.
Okay, so Airbnb, when they launched, I think they were valued at the time where they were valued, I think at $20 million. I think they were in 1 or 2 states in the beginning. And then the very famous company called Rocket Internet, which owns just about every other food delivery app in the region or in the world, let's say, decided to go like, hey, we like Airbnb's model. And instead of investing in Airbnb or acquiring Airbnb or pitching anything, they had decided to take up $200 million and launch something that's completely a knockoff of what Airbnb is in Europe, to be able to make this massive company to compete with Airbnb and basically eat up the market there. Ultimately, because Airbnb is backed by the likes of Sequoia Capital and so many big names, it could trigger a merger or a potential acquisition. Nobody knows. So I don't know what they were thinking, to be honest. But the whole aspect is, hey, let's eat up their market. We're going to compete with them. We have deep pockets. Let's burn this cash and get the European market before they do. Funny enough, Airbnb decided to just work on their blitz scaling capability. So by blitz scaling, it means as if you're throwing yourself off of a cliff on a rocket launcher and trying to build a plane going down. I don't know if that makes sense or not, but that's just the perfect example I can give. So they start burning cash to be able to focus on their product and grow it as much as possible to their loyal customer database. Because in the end, that company with 200 million was just a company trying to grow one way or the other. Airbnb, on the other hand, was more of a solution, more of a support scheme, more of, hey, I have this loyal customer database that I'm just going to continuously going to offer more solutions to. And ultimately, this individual is going to talk to his friend and her friend and their friend. And I'm going to be able to acquire more loyal customers that can pay me a bit more stable and more stable money for a specific period of time. And I'm going to be able to eat up the market because they added value. They focused on value, right? So you have to focus on how much value you add. First thing is you have first to market advantage. So you know the market a little bit more than the competitor that's going to jump in with a lot of cash. Second thing is you know that you're adding a decent amount of value. So you got to be able to have this culture that's kind of like, I would say, contagious towards what the clients that you have that will allow them to just stick, create that stickiness. And then ultimately just focus, ignore that. Okay, know in the back of your head that there's a competitor working and doing this to eat me up. Know that they're gonna, come up with something to kind of like piss me off at some point down the line. But ultimately, there are two scenarios that could happen. If you really focus on the value, and if you focus on your growth, focus on your product, increase and add more value as you go. One thing could be is the competitor is going to run out of money and just go away. Or the competitor is going to realize, oh, you know what? I think I should either invest or acquire this business because I don't know what the hell I'm doing, and they're just going to give you the money. We tend to be scared of competition. Don't be scared of competition. Think of competition as an opportunity for you to prove that you can add more value and add more value. Yeah.
Okay. Thank you so much for the time and for coming on.
Absolutely.
Really appreciate it.
Absolutely.
And I know the teams do too. As their deadline is Monday for selection committee. So thanks for your wisdom and advice. It's so great to have you on.
Absolutely. Thanks, Dave. Thanks, guys, and good luck. Good luck. I think I'll be seeing you again sometime soon. So,
great.
Bye-bye.
All right, we're gonna take an hour now for lunch. We'll see you back in an hour. I'll drop the Zoom call now and pause the recording, and we'll see you back in an hour to talk about your go-to-market strategy. All right. Thanks, everybody. Enjoy your lunch.
Thank you, Dave.
Thanks, Dave.